This is the current federal tax developments for the week of February the 10th, 2025. Current federal tax developments are brought to you by your state society of CPAs. And I'm coming to you again this week from here in Phoenix. And if you're looking at the slides today on the video version of this, you're going to notice that we have a somewhat different look. That's going to be going forward from this point, so be aware of that. Otherwise, though, basically we're doing much the same as before. This week, we're going to be talking about a few things in this area. First, we're going to talk about an IRS letter ruling on an IRA that was left to a trust, eventually to be divided between charities and individuals. So we'll talk about the IRS decision on whether that in fact functioned properly, what it did to require distributions, and other issues. We'll also talk about a taxpayer who mistakenly believed that the IRS had conceded that he didn't owe self-employment tax on income that was pretty clearly self-employment income. And unfortunately, he suffered the consequences of this. So we'll talk a little bit about that. We also have the tax court denying a taxpayer's deductions and claim partnership losses due to incredibly disorganized and inadequate records, which the tax court made clear that the judge was not going to sort through piece by piece, trying to figure out what related to what. Kind of a lesson of, if you're going to go to court prepared is probably a good line there. Probably go to the exam prepared too would have helped in this case. Next up, a taxpayer who runs afoul of the pay first, litigate later rule. When they attempted to, in response to an IRS assessment, rather than taking the assessment to the U.S. tax court to dispute, they rather, because they hadn't filed a return, they prepared a new return that now claimed a refund, and they then set to file suit in U.S. District Court. And the Fifth Circuit points out that, it's not how this works. When there's an assessment in play, and you've blown your time, you don't go to tax court, you got to first pay that assessment before you can litigate, even if your argument is that you're owed a refund. And that was what bit the taxpayer here. We also had a taxpayer that apparently got confused with an unprocessed employee retention tax credit claim and had some significant unpaid payroll taxes on 941s, and who was trying to argue not initially that they wanted any sort of collection due process collection alternative, but rather that because they had that outstanding refund, there really was no balance due. So, just kind of ignore and make the whole thing go away. That didn't actually work either, as we'll discuss. And the Corporate Transparency Act, the Beneficial Ownership Information Reports, now returned to you. In this case, not quite yet to do anything with, but we did get the first filings from the new administration regarding the position on the CTA. There had been some speculation, you'll see this all the time with the change administrations, that the approach to the case might change, even to the extent of maybe, they would stop litigating the matter. If you were hoping for that, if you're hoping for stop litigation and this thing will just go away, that does not appear to be. We have had two, and I have now got a report of a third filing last week. So they're going down this path. But we do have a proposal that may be some changes in the works, and we'll talk about that. And while a deadline may come up very quickly if they get the relief they're seeking, there may be some changes in who has to file, which means you may need to learn more about the BOI and what the then current reports will be, the current requirements will be in the middle of tax season, which I'm sure you all would look forward to. But let's start out talking about a private letter ruling, 2025-06004, issued by the IRS on an IRA account that was left to a trust. Okay. This particular case, we're going to talk about the background facts in this case. The decedent in this case left her retirement accounts, her IRA accounts, to a trust, right? And the trust was going to distribute the funds. And what would happen is they'd first give IRA funds to a private foundation. They were going to withdraw the funds from the IRA account, distribute a set amount of those funds or a determined amount of those funds to the charities, which would be a private foundation in this case. And then the remaining funds would be divided up among the beneficiaries, but they wanted to keep them in IRA accounts, a trustee-to-trustee transfer, rather than have the money come out right away, all at once and have it all paid. They want to be able to distribute it to the beneficiaries. The question becomes, does that work? And point out before we get into this too deep, remember this is a private letter ruling. It only applies to this taxpayer, but it does have some interesting discussions here in the structure. And no, I don't know why they arranged it this way and why the structure. I suspect it has to do with details in the trust and how the charitable component was going to be computed and various structures along that area that they really couldn't get into a IRA, beneficiary designation form to work easily. It's probably the problem here as to why they went down this path. Now, the issue was, can the trust, first issue we have is when the distribution comes out of the IRA to the trust, and by the way, the trust is going to only exist for long enough to get these IRAs distributed. So the question becomes, when that money comes out, and then we distribute it to the foundation, is that going to be considered taxable income to the trust? And if it is, which by the way, the trust rightfully decided yes, it was, would the trust be allowed a deduction, right? In this case, under 642C1, a charitable contribution deduction, when it distributes those funds to the trust to the charity in the same tax year. So the money comes out. So basically, let's say we take a $200,000 distribution. That money comes out of the IRA account. The trust has that as income, but it's going to distribute the funds, which represent income in respect of decedent under the federal tax rules. It's going to distribute those funds directly to the charity. Now, generally, you can't take an income distribution deduction for distribution to a charity from a trust, assuming you meet the requirements for a charitable contribution. All those issues, or even if you don't. In essence, trusts are not charitable beneficiaries. You have to get them out through the special rules of 642C1 if you want a deduction. Those deduction rules provide for various options if you have contributions that are authorized by the trust, right, and that come out of income. So the key question here, and there really are two people may sometimes have confusion about here. The first thing is, because we know about the definitions of accounting income and what's income of a trust, is that the income we're talking about? Because in most cases, for most principal and income acts and under most trusts, amounts taken from a retirement account would normally mainly be considered principal because it existed, it was transferred there. It was existing principal when the trust was funded. But it is nevertheless taxable income. Now, the interesting discussion here, if you look at 642, is that 642C1, they discussed about the necessity of the contribution coming out of gross income. Gross income is a term you will not find in the Principal Income Act. It is a term that you will find in the Internal Revenue Code under Section 61. And generally, we've had rulings that have held that reference, because it has the modifier gross, generally that means you look to the tax definition of gross income and not to try to make it fit under the Principal and Income Act. If you just have income by itself under any references, the way the code's structured regarding a trust, we're normally talking about income computed under the trust document, which normally relies almost entirely on the applicable Principal and Income Act, or I guess now we're on the Fiduciary Income and Principal Act in certain states. So whichever one you want to call it, we're under those rules. But again, in this case, because it is a tax gross income item, the IRS said, yes, you will get a charitable contribution deduction on Schedule A of Form 1041, and it will be based on 642C1. That will not be a problem for this trust. Okay. Next up. Now remember, now we still have now a bunch of funds left in the IRA. The trust has taken its first distribution out of the account. Now there are a bunch of funds left in the IRA. The trust is now going to divide up those remaining IRA funds and transfer them into IRAs in the names of, for each of the individual beneficiaries and it would be an inherited IRA. Now, the question is does that work? The question the trust posed was, are these transfers where we try to get it from a one big account with the trust as the inherited IRA beneficiary and move that into a bunch of separate IRAs with the individual beneficiaries of the trust now named as holding the funds? Is that a tax-free transfer? Or is that a transfer that is considered to be taxable, right? Is it a taxable transfer? And the IRS ruled in this case that these transfers are not considered to be taxable distributions under either IRC sections 402C or 408D1. They are rather considered to be direct rollovers, is a term the IRS will consistently use, in essence, transfers. You generally cannot make a traditional take money out, put it back in an account, roll over on inherited IRA. And we have the other problem here that, remember, the trust was the beneficiary of this thing. And it's not your traditional pure conduit trust where we were able to, set it up in that kind of traditional form. So we're trying to figure out, are we okay here? Because the trust had its computations, and then we kick it out to the heirs. Well, what the IRS said, it's fine. The inherited IRAs are to be titled in the name of the decedent, so Mary Jones, whoever, for the benefit of, and then you name the specific beneficiary. They each get an IRA account, right? Inherited IRA, and it is a standard inherited IRA that they're going to be subject to those rules. So again, they can't borrow, quote unquote, as clients like to say, from the IRA and put it back in within 60 days. But they're holding standard inherited IRAs. It'll be considered a death benefit, so therefore not subject to premature distribution penalties to the extent that the owners, the holders of the accounts are under age 59 and a half. So there's no problem there. We get it out there. Next up, we're going to ask about whether or not, how does this affect the required minimum distributions calculated? And who's responsible for the taxes? Now, the IRS ruled in this case because the trust was the beneficiary named in this case, and it wasn't a pure conduit structure, that in essence, the RMDs must be based on the decedent's remaining life expectancy at the time of her death, right? So, and I realize that seems like a weird concept. You would think, when you're at the funeral, the person in the casket's remaining life expectancy is 0. But for actuaries, this makes sense. It would be the life expectancy of Mary had Mary not died. And while that's kind of a big, yeah, but she did, we can deal with that. And we're going to look at her life expectancy had she not died. And they would be able to essentially use that as their life expectancy. Now, again, the 10-year rule would still come into play. So by the end of year 10, at the end of year 10, everything has to come out. But they would use Mary's life expectancy. Now, Mary, who's a decedent, likely is significantly older than the beneficiaries. And so that's going to be a more rapid distribution and may, in essence, come out so the 10-year rule isn't really a big deal. In this case, conceivably, it could be less than 10 years. So, very easily could. So it's like, yeah, we may not really have a 10-year problem here. But each inherited IRA is independent when calculating RMDs. So the good news is we don't still have to calculate them as a whole, right? If Mary's IRA goes to, let's say, her granddaughter, Janine does not care what her brother Walter does. Janine just looks at her account. Walter looks at his IRA. Each goes separately. Again, the factors you're going to use, divisors you're going to use, going to be based on the decedent's life expectancy at her death, but the balance is going to be the specific heirs IRA and what that balance is in that L, right? And again, the trust is not, we're not going to have to keep the trust around for 10 years. The individual beneficiary is responsible for tax liabilities from those distributions from their inherited IRAs. So bottom line, the structure was ruled by the IRS in this case to work. It's a 10-page ruling. It is messy. It is complicated, but it is an interesting ruling to take a look at. Next up, we're going to go to Tax Court Memorandum Decision 2025-13, the case of Clark v. Commissioner. This is going to look at self-employment tax and accuracy-related penalties for the taxpayer who got a little confused about whether the IRS had actually waived the fact that he wasn't subject to SE tax. Now, this taxpayer was James Clark. He's a freelance writer, and he sold movie memorabilia. Now, I'll admit, reading this case, I began to wonder if whether James had really screwed this up in another way, which was not discussed by the court. He didn't raise it. They didn't discuss it. But it doesn't appear that he was claiming any cost of sales for selling off the movie memorabilia. And unless he was just getting free handout posters somewhere that he'd have no basis in, it would seem like there probably should have been a deduction that was never mentioned, but it doesn't matter. Now, he got a form, 1099K, because he sold this stuff, as I recall, on eBay and other locations. And he just reported it as other income not subject to self-employment tax. And that was true both of his work as a freelance writer. He would do movie reviews, and it was his, his very regular sales of movie memorabilia, right? Now, the IRS obviously, took a look at that. The computer did and said, hey, James, this is SE income. I know you put in the other income line, but it's SE income. And, or at least your preparer put in the other income line. But it still should have had self-employment tax paid on it. The IRS issued, therefore, a notice of deficiency. And things got a little messy here. And what happened at the end of the day was they prematurely finalized the assessment, right? Remember, generally the IRS issues the 90-day letter, the proposed assessment, and you have 90 days to file in the tax court. James filed within 90 days. Now, it gets a little weird here because apparently there was a long-term, I don't know, we don't know if it was lost in the mail or the tax court managed to foul up internally. The clerk's office somehow lost it, misplaced it. But anyway, it took a number of months for the fact that he had filed a tax court petition to actually be noticed by the tax court and recorded. And because it was never recorded, the 90-day deadline went by. The IRS was never told. They're watching from the tax court to get a notice that this particular taxpayer had filed a case. They see no case filed, so they finalized the assessment. Now, because James had filed the tax court petition, that was premature. Once the taxpayer files a tax court petition, the IRS has to put the, filing the assessment on hold until we finalize and get a, decision out of the tax court and it becomes final. So the IRS had failed to do that. The IRS had therefore recorded the claim, right? Recorded that tax as now due from James. And of course, presumably started mailing James about it. And also notified Social Security about the fact that he had self-employment income. Okay. Once the tax court recorded the case and notified the IRS, took one look and said, well, this assessment is not valid right now. It was premature. So they reversed the assessment and they notified Social Security that, hey guys, pull off that SE income right now. Right? So, and they also, because they reversed the assessment and because James' initial return showed a refund, they issued a refund because that litigation hold was not in place. So the refund was still payable in that scenario, right? They still had to process a return and pay the refund because there was no additional tax due on the account right now, right? That had been done. So now James is sitting there and essentially he's now gotten a refund. He did check with the IRS and, Social Security and finds there's no record with Social Security of, him having self-employment income. Now, again, you can go online, you can check that. So that's when James decided this was absolute proof that the IRS had given up on the case, right? He argued that they'd conceded the issue. They had reduced his self-employment income to zero, and they had done that with the Social Security Administration, and they had given him a refund based on the fact he would owe no self-employment tax. So because they had conceded it, then really there was nothing for the court to decide, right? And I got to realize it is a little funny here because this was basically a mistake either a mistake of the tax court or a U.S. Postal Service error. But it wasn't really the IRS's error, and it wasn't James's error. So that's an interesting case to read because it becomes obvious where the problem was, right? So the court said the IRS's determination of a deficiency, their proposed deficiency, is presumed correct, and nothing that had happened changed that. In the tax court, it's presumed defect. The letter from Social Security Administration was for Social Security purposes only. You weren't going to get credit for that income right now, because currently, there's none. We're going with your return because the IRS told us they jumped the gun, right, and brought that out. And the IRS refund was a procedural correction to remedy the premature assessment that occurred because it took a number of months for his petition to actually make it and be recorded, and the IRS notified that a timely petition had been filed. So because of that, the court determined Clark was self-employed and Clark was liable for self-employment taxes. Now, the next question comes up, because now we're back to square one. Was he liable for an accuracy-related penalty? Well, the court found that his understatement met the requirement for a substantial understatement, right? If it's more than 10% of the tax due or $5,000, whichever is less, essentially, you owe SE tax. Now, that changes and becomes even a lower number if you claim any Section 199 Cap A deduction. No, I can't give you the total logic for why they did that, but yeah, because it's not required that the assessment be related to 199 Cap A, which is a whole nother long discussion. It's a weird section, but we've got it. Now, that penalty is automatically calculated, and it's, the code just says it applies. So we've had lots of cases, and the tax court now checks every time about whether the IRS did proper supervisory approval. We've had a lot of back and forth on that. But they said in this case, because it is simple mechanical, the IRS doesn't really propose this penalty. The code says that if you have a substantial understatement, you owe a 20% penalty on the tax. And now it's up to you to either show the position in question had substantial authority or that you had a reasonable basis for doing this, right? Reasonable cause. And Mr. Clark did not demonstrate reasonable cause for why he didn't report these, why these weren't reported as, business income subject to self-employment tax, because it was a full-time type job. He had been around. It was, not clear why he was, why he thought it was justified. And he wasn't really arguing it was justified. He was just arguing the IRS, had said, hey, it's okay. And they hadn't. And, you might think, well, this is unfair. But the argument is really no. Here's the problem. This penalty question existed on the day that the IRS issued the proposed assessment. This penalty would be due. The burden would be on James to get rid of it. So it wasn't really that he was penalized because he thought the IRS waived it. That waiver occurred well after the return was done, well after everything was together, that his supposed waiver. So it's not he's being penalized for thinking the IRS had waived the tax. Rather, he was being penalized because that ship had sailed back when the IRS had issued its notice of proposed deficiency. And right, he's not really being penalized because the tax court got it wrong. So the court ruled in favor of the IRS, and Mr. Clark was found liable for self-employment tax and the accuracy-related penalty. Next up, we have the case of Langlois, I'm sure I got that name wrong, versus Commissioner, Tax Court Memorandum 2025-12. Now, this is a substantiation case, or better yet, lack of substantiation case, is what we're going to have in this particular case, right? So Tax Court Memo Decision 2025-12. Now, in this case, Thomas Langlois was a union power line worker with a couple of entrepreneurial ventures. He had claimed significant losses from partnerships. Forbearance was a partnership he had put together, a business opportunity he had put together with another person. And he was going to be the theory was to be like a contract power line worker, to deal with big storms, et cetera, with various utilities. It turned out his timing was bad and the market never developed that he thought would. So basically, yeah, it never really had a lot of income. There were a lot of expenses claimed on the 1065. So keep that in mind. Then he also had a hair salon, or hair salon was the name of the place. It was, as you might expect, a hair salon. He was not involved in working directly in that, but rather he had gone into partnership with somebody who did have a background there, who actually did the day-to-day work managing the salon, and basically handled actually hiring the hair, or getting the contract hair staff in there to do the work. Again, this one lost a ton of money too, at least per its 1065. And then he also claimed a bunch of unreimbursed employee business expenses on his power line work. Again, so this is a pre-2018 year we're looking at here. Tax court cases take a while to go through. So he's also got these employee business expenses. Now, the IRS disallowed almost everything due to a lack of substantiation. And, so Thomas filed suit in the tax court. Unfortunately, he didn't get the hint about the fact that his records were a problem. Right? Now, he argued he was entitled to deduct the unreimbursed employee business expenses, which were tools, clothing, and travel, and the partnership losses. He said he had made extensive capital contributions to the partnership. Right? Now, the problem here is he might have been entitled to both. But the problem was lack of records. And so the court came down. Under Code Section 6001, taxpayers must maintain sufficient records to substantiate deductions. Now, the court didn't deal with Cohen here, but even with Cohen, you've got to have things that are in a reasonable shape to reasonably estimate the true amounts, even if the records aren't there. And there's no real evidence that Thomas had much of anything except a really, really big shoebox, apparently, with a bunch of receipts that didn't really indicate what they were for or which thing they were for, etc. Weren't organized in any way to tie into what was being shown on either his employee business expenses, or either partnership. Didn't do any of that, and certainly didn't show what had been contributed as capital by him to the partnership. Right? Because and what had really happened is, which unfortunately makes sense when you realize how disorganized this is, it appears that what he really probably was doing was, whenever the partnerships would incur some expenses, he might pay them personally. But again, his records were a disaster in that case, right? So for his personal stuff, he did not show tools and clothing were required for work and not for personal use. Remember, you've got to be able to tie it back to the business use. He needs clothes. He needs clothes. People have tools. I'm a CPA. I have tools, right? I have, hammers and screwdrivers and all those neat things, but not really related to my work, right? Don't usually need that stuff at work. And the travel expenses were not shown to be for work, right? And he did not prove he was not entitled to reimbursement. That's the other thing you got to prove with these things. You're not, are you entitled to be reimbursed for your travel? He never showed any of that was true either. Again, lack of all records. He couldn't prove what was for work. And remember, travel does fall under 274, the Cohen rules, basically the anti-Cohen rules were added. So their lack of substantiation, it's dead before you start. But even with Cohen in place, lack of substantiation will still kill your deductions unless you can meet the Cohen standard of having a reasonable basis upon which to estimate the proper expense. And again, what the court described was the proverbial shoebox. But even a bad shoebox, in essence, a really bad shoebox situation. For the partnership losses, he failed to provide credible evidence of his basis to the partnership. Nothing was documented, nothing was in place. He couldn't show capital contributions. He could bring out receipts, but, it was a receipt like to the partnership. Now, he claimed he paid it, but had no way but he didn't have any record to tie that in. Couldn't show he was not subject to reimbursement, even if he did pay it. There were all kinds of problems here, right? The records were insufficient to establish the business purpose for these expenses. And therefore, they couldn't establish basis for him because, it would only be basis if it was truly contributed to the partnership. And again, his records were just horrendous in that regard. So in the end, the tax court ruled against him for lousy and horrid records. The court simply said he didn't meet his burden of proof regarding the deductions. And those inadequate records resulted in that disallowance of deductions and the imposition of an accuracy-related penalty. So remember, he had both. He couldn't prove what he had paid for outside the partnerships. And even though the 1065s weren't being challenged, you still got to have basis to claim that loss, and he couldn't prove basis. So all of it was thrown out. Horrible records. Now, bad records do cause a lot of losses or lack of records in the tax court, but they aren't generally quite as bad as this. This was a rather extreme case. Now let's go to somebody else who had a bad day in court. This one, though, went all the way to the Fifth Circuit Court of Appeals. This is Ballantyne versus United States, case number 24-40212 from the Fifth Circuit in 2025. And this deals with when you go to district court, there's a rule called the pay first, litigate later rule the court referred to here. That is required if you're going to sue the IRS for a tax refund. When the IRS believes you owe tax and you're going to go to court to try to get a refund suit going, you got to pay the outstanding liability first. And that's what the taxpayer ran afoul of here in Ballantyne. Now, the Ballantynes had failed to file their 2017 income tax return. So, as will happen here, the IRS prepares a substitute for return and assessed a penalty of $1.2 million. So they had this tax due, they had these penalties due, right? All of which were assessed there. And, meaning essentially the IRS notified the taxpayers, came up, the assessed $1.2 million was there. That, of course, got the taxpayers' attention. So they suddenly prepared a return and claimed a lot of losses that ended up showing that they were owed a net refund for the year. Now, again, those losses are in dispute. So what happens now is the IRS, and the taxpayer, right, are going together. The IRS still claims they owe them the million plus is still at least owed to them, right? And they can't, and that they have no right to sue for a refund for anything else until that problem's taken care of. The taxpayers, of course, in this case, the district court agreed. The district court cited the case of Flora versus United States, U.S. Supreme Court case, which required a full payment of an assessment before a taxpayer can sue the IRS for a refund, right? It was basically said that, you can't have, if the government has a balance due outstanding on you, remember, we get back to sovereign immunity. In essence, the government can impose conditions on when you can sue them because they're the sovereign who normally can't be sued. That one of the conditions imposed is that, if we're saying you owe us money, you got to pay it and then sue for a refund. You can't come back and just sue us right away without having the payment made. And in this case, the Fifth Circuit upheld the dismissal. Again, they affirmed the jurisdictional issues must be addressed first. They said, look, you're trying to get to the merits of your case. That's what you're arguing. But the pay first, the bright line rule, to pay first, litigate second rule, that rule says that no, that's not how this goes. You don't get to argue the merits of the case until you have a court that has jurisdiction to hear your case. And under the pay first, litigate second ruling of the U.S. Supreme Court, when they interpreted the U.S. Code provisions that apply in this area, you got to pay the tax due first. There is no option to come in and say, we don't really owe you money and you owe us money. Even if that's true, you can't go and sue them at this point, right? There were options not to pay, but, in this case, the taxpayers never actually took advantage of it. Now, the precedent came from a U.S. Supreme Court case. A federal district court does not have jurisdiction over a tax refund suit when the taxpayer has not paid the full amount of an outstanding tax assessment. You must pay up, any assessment that exists, right? When you file suit, if that is a final assessment, you got to pay it up, right? Or even a proposed assessment, right? Your alternative was, and what they should have done was gone to the taxpayer, was gone to the tax court, I should say, U.S. tax court to dispute the $1.2 million penalty and the assessment in general. And at that point, then you can argue the merits, which would have included arguing that the service owed you money back. But they screwed it up by not challenging in tax court. They really don't say here why they didn't, but I have a real sneaking suspicion that potentially they had blown the 90-day rule, right? They were behind, didn't do things, probably didn't get the other return together, didn't have any facts together until well after the assessment was final. That's just tough luck, right? Once that assessment is final, the only way to work out of it, unless you can get the IRS to give you some sort of, you get collection due process hearings, you can get, offers and compromise for doubts with regard to liability. There are backdoor ways you get audit reconsideration, those things like that, but you have no real way to force the issue with the IRS, with the courts, because you've got to pay up first. So you pay up, you can't go get your refund, right? So the bottom line implication, remember, if there's an assessment, the taxpayer must pay the full assessment before suing for a refund in the U.S. Federal District Court. That's kind of the big issue coming from this, and this is why, yes, attorneys should get involved. Once the clock's running on a 90-day letter, you kind of got to tell the taxpayer that realistically, you need to talk with an attorney. There is a 90-day clock running here. And you need to be at least ready to litigate, in terms of that, if you're not just going to pay it. As I tell people all the time, it doesn't really matter, when that 90-day letter is running until the IRS formally withdraws the letter. You got to work like it's there. And yes, people do file tax court petitions. It gets sent back to appeals and they solve everything there. That's correct. But as I was told years ago by an experienced CPA, that's all true and all correct. But, if a taxpayer wants to file in tax court to get their second shot at appeals, they do have to be ready in case appeals denies them any relief, right? To potentially argue this in tax court. They're going to lose their rights, unless they know how to do that. So unless they do that. So you probably need to have a plan, at least invest enough with getting an attorney involved to understand whether it's reasonable for you to attempt a tax court challenge if it comes up, or what we're going to do. Because, you set the plan in motion, the case will be calendared, and eventually it'll be called. And if you don't settle it with the IRS ahead of time, in that case, and at that point, we're going to have a final tax court decision, and that's going to block you. You chose your path. So understanding pay first, litigate later, and the basic rules that apply. Remember, you can always challenge the IRS's findings in either the tax court, district court, or court of claims. But there are different rules for each, and there are different requirements. Remember, the tax court is the one that you can go to without paying the tax due. That's the big advantage, and also why we tend to see vast majority of cases are tax court cases, not district court. Next up, I always love names like this because somebody got picky. People lease, or I don't know how, because they're combining people and lease. So you write out people, add ASE at the back. So basically, an employee leasing company is the presumption here. LLC versus Commissioner, Tax Court Memorandum Decision 2025-14. The IRS had a levy for unpaid liabilities, about $11 million. Taxpayer is saying, no, but we have an outstanding employee retention tax credit refund claim that will wipe all of that out. The IRS just hasn't processed it yet. So we're here with an unprocessed ERC claim, TC claim. What does that do when a taxpayer, which they eventually conceded, yes, they owed $11 million they had not paid on the 941 in question, and other 941s came in play later as well. So they conceded, yeah, they did. But, what happens though? Now Congress suddenly turns on the ERTC, they qualify, and they have this big refund they claim to do, and it would wipe out what's due. Does that have any impact until the IRS actually processes the refund claim? Well, we'll get here. This is Tax Court Memo 2025-14. Now, the IRS issued a final notice of intent to levy for unpaid payroll tax liabilities, about $11 million worth. Okay. Police requested a collection due process hearing, essentially claiming that they had this big pending employee retention tax credit that would resolve their liability. Now, at the CDP hearing, the IRS requested additional information on the claim, but the taxpayer didn't provide it. Okay, that probably didn't help matters here. So they're saying, look, we got this big claim. It's been filed. The IRS, has it in play to be processed. The IRS, agent assigned to the CDP hearing says, well, give me information about this claim. What is it? What's going on? They didn't do that there. Now, again, we don't know why they didn't. Not quite sure. They didn't think it was proper. It should go through the other process. Maybe, you start wondering if maybe one possible theory someone could have for doing it that way is, well, our claim's not really very good, but we know they're flooded like mad over there trying to process these. So we got a really good chance we're going to get paid if it stays in the big pile. Take a while, we'll get paid. If it comes over here and an individual agent is looking at it personally and in detail, then we probably got to answer a whole lot more questions. The theory being that, no, we like it in the big pile. No, that's the thought pattern. Maybe they were just sloppy and simply didn't respond to anything. I mean, there's not really a good answer for why they didn't do it, but they did. So the information was not provided. And of course, IRS therefore said, nope, no relief. We're going to file the levy. Now, police, of course, went to the tax court and appealed this, right? Said, we're no good. Now, they argued that ERTC claim that would eliminate the liability should be taken into account. But as noted, the court points out, however, the IRS requested this information to process the claim. You didn't respond to it, right? So the appeals officer issued a notice of deficiency. That's how this sort of thing gets played out. Now, the tax court said its review is limited to whether the appeals officer abused her discretion because there was no dispute that there's $11 million liability. So did she abuse discretion in saying, go ahead with the levy in this situation? And any issue that was not raised before the appeals office cannot be considered by the court. And the court also has no jurisdiction to determine there's an overpayment of an unrelated liability. So they're saying, look, you could have got this in the record by putting all that material in the record in front of the appeals officer, but you didn't. So, not doing that, she's not outside of her discretion to ignore that. You guys owe me tons of money, but I'm not going to tell you the details. You just owe me tons of money. Is kind of the position. It's like, it's not abusing discretion to keep collecting. You ever been in any business where you have, people who don't pay their bills? They always have a good excuse. And they'll have theories like that, and you can't ever get details. And it's like, yeah, that's not an abuse of discretion to say, nope, you owe it, we're going forward. So the court said, look, we can't adjudicate the ERTC claim because you never got it on the record. And it's not really something we have jurisdiction over anyway. So it's not on the record. It doesn't get into this. We can't consider if she should have considered it. And we can't automatically say you're owed the ERTC money today. Sorry, because I think they got a little desperate at the end, decided, well, okay, we better do something now because the $11 million, the levy is going in place. So we need to do something. Unfortunately, they didn't. So the tax court granted the IRS's motion for judgments on the pleadings, and the appeals officer did not abuse her discretion in sustaining the levy because the taxpayer failed to provide the information related to their claim. We talked about that last week about how, just not providing information If you're not cooperative in the appeals hearing, the CDP hearing, the courts aren't really going to back you up. And last week appeared to have much better reason. Obviously the IRS has screwed up multiple times. At least you understood the frustration. Here it's like, you should have given her stuff, right? Had that been on the record, we might have been able to decide that, she abused her discretion by not, holding back on it. But you didn't do that, right? A mere claim for an overpayment is not an available credit. You still owe $11 million as of today. And, it's not ours. If you want to get this claim moving, as we've talked about in the past, right? It's been more than 6 months your claim's been outstanding, which is probably certain is true here. File suit in district court. If you win there, then, you're able to go for it. This is a separate claim. The pay first, litigate later rule wouldn't apply there directly because this is looking at a separate claim and a separate issue. The balance due is a balance due that's out there, but it's separate and apart. So, in fact, as I recall, it was a different quarter, and this would just have freed up money. So, yeah, you need to go through the other process here. You can't go this route, right? We're not going to do it for you. Okay, I'm sure you can't wait. You've been probably so bored because we haven't really had much in the way of BOI discussion for the past week or so. Ever since the Supreme Court overturned the Texas Stop Cop Shop stay, but we discovered that there was another stay that was keeping everybody from having to file anyway. And so we didn't really know where we were going. Now we have some guidance. We're going to have two separate cases or two separate filings by the government. Now, these are interesting because, as I stated at the beginning of this program, there was some people wondering, would there be a change in the approach to litigation of this issue and how they're handling this, the whole BOI reports by the incoming administration? Or would they continue with the cases that they had? And arguably, it could have gone either way. You don't know. Now, I was thinking there was a good chance the administration would keep pushing on this for the simple reason that I hadn't heard anybody say anything related to the incoming administration or even on the campaign trail about the CTA and this BOI reports. It didn't appear to be to them an issue that they were going to go fight over or that they had a big beef with the current administration at the time over, right? They weren't raising this issue, and they definitely were raising issues about other things. They just weren't ever raising this issue. Well, if you were hoping for a 180-degree turnaround, yeah, it looks now like that's not happening from the government's position. We do, though, have an indication maybe a 20-degree turnaround. Maybe it's in the cards. We don't know. We don't know if it's a 0-degree turnaround, a 20-degree turnaround, or a 100-degree turnaround. Because we have very little information about the turnaround, but we'll discuss it. This came up in a filing in the case of Smith versus United States Treasury. Now, for those who don't recall, the Smith case was the second U.S. District Court of Texas case, Eastern District of Texas, I should say, case that issued a nationwide injunction against enforcement of the Corporate Transparency Act's rules. This injunction came after the case had been given to the U.S. Supreme Court on overturning the Fifth Circuit's restoration of the Texas Stop Cop Shop stay after the Fifth Circuit had blocked it. That was the Fifth Circuit overturning the Fifth Circuit, as you may remember. And then the Supreme Court just says, skip that. It's out. It's gone. And there's really nobody that can overturn us 9. So I think we're done with that now. 8-1, I guess. There was one who didn't want to take the case, but 8-1. So we're there. But because this other case was there that wasn't covered by what went to the Supreme Court, this other stay remained in place. This was a case of Smith versus United States Department of Treasury. The government is filing what's entitled the defendant's motion for stay pending appeal. And the issue related to the preliminary injunction against the enforcement of the Corporate Transparency Act that was issued by the court in Smith. And what the government is requesting here is yeah, why don't you just stay that order? Basically, which is a nice, kind way of saying, uh, pretend you didn't issue at least the nationwide part of the order. Right? Let's go ahead and we'll stay it till the case is over, which if you stay a preliminary injunction till the case is over, you pretty much have gotten rid of the preliminary injunction and you're going to wait to get to a final injunction. So the government has now requested that nationwide stay. Now, an interesting fact was there was a third U.S. District Court of Texas case, the U.S. District Court case in Texas, where the taxpayer also was in there requesting a nationwide stay. And in that case, the judge, unlike the judge in the Smith case, says, there's already a nationwide stay that was imposed by Texas Top Cop Shop. That judge rules, I have no relief I can offer you because you've already gotten relief. So yeah, that judge decided, unlike this one, that he couldn't stack up an extra one. Because what happened in this case was, and I think the judge in this case it's very clear, he knew that's what he was trying to do, was have a stay that would survive the Supreme Court overturning Texas Top Cop Shop. I'm not sure what he thought the end game would be, because if the Supreme Court overturned Texas Top Cop Shop, there's a really good chance that if they get your case, they're going to throw it out too. But okay, he tried. So now the government is saying, yeah, you tried. Why don't you just now quit while you're ahead, or at least while you're not quite as far behind as you would be. And why don't we pull this out, right? Let's go to the background. In case you've forgotten about the CTA, the Corporate Transparency Act requires certain companies, most LLCs and partnerships, to disclose ownership information to the Financial Crimes Enforcement Network, FinCEN. Now, FinCEN had issued a final rule implementing this Corporate Transparency Act in September of 2022. And under that rule, compliance deadlines were established, so businesses were formed before 2024 were required to comply and get their initial reports in by January 1st of 2025. Obviously, in September, things started happening rather rapidly. And effectively, that January 1st date is currently still being held up by, at this point, this particular case, the Smith decision for the nationwide, and in a separate case that it actually was issued back in March and is waiting an opinion of the 11th Circuit, a specific set of individuals who are the plaintiffs in the case are also insulated from the January 1st date. Now, so far, IRS, the FinCEN has not even questioned, while they're appealing the decision, like they did the 11th Circuit, in the case in Alabama, they didn't go for an emergency elimination of that. As far as they're concerned, those people wait till the dust settles. And they will have to file or not file. They didn't worry about that, but they do worry about these nationwide ones. So now the IRS, or not the IRS, but the feds have come in and said, right now, the defendants, that's the government, is requesting a stay of the injunction pending the Fifth Circuit's decision. In essence, they want a duplicate of the injunction that was issued by the Supreme Court in Texas Top Cop Shop. Okay. FinCEN says if this stay is granted, their intention is that the CTA compliance deadline would be 30 days after the date in which the stay was lifted. Now, they don't completely say that in the motion they filed, in the brief they filed, but they did put an announcement on the fincen.gov/BOI website, the most recent alert, that, says it that way, 30 days after the stay is lifted. So if the stay was lifted, today, let's say here on Monday, they lift the stay on, February 10th, then we'd be getting 30 days after that, which I believe would be March 12th. By the way, get very nervous because you know what that's really close to. And as I mentioned, I was doing a tax update, and I mentioned when that 30-day rule came up that, that's probably the worst case scenario if you have clients that haven't filed and that are looking for you to assist them, is to suddenly have the deadline pop up right in the middle of March, or basically anywhere from around March 10th to until April 15th. Because, again, they are going, and this is what even makes it tougher if that deadline comes in. They're going to assess where to modify the reporting rules during the 30-day period. Now, the big question I have is, at what point during the 30-day period are we going to be told what the new rules are? Assuming we have new rules, are we going to be told, or when will we just be told there are no new rules? Do what file under the old rules. Because they're not committing to new rules. I suspect they will issue and have some relief provisions in there. But it's like, wait, you're tying it to 30 days from when the stay is granted. When the stay is granted so that now you can enforce it again. But you're not committing to when we're going to know what relief we might get. And it's like, guys, why don't you make it 30 days after you decide if you're going to change the rules, at least? Okay, so that's also part of the mess that we've got. So be aware of that right now. Now, the government makes all of their standard arguments. This is also important because the arguments they're going to make for the stay, aside from adding the Supreme Court's decision, are the same as the arguments they've been making all along. They're the same as the arguments back when the name of the case was not Texas Top Cop Shop versus Bondi. By the way, the name changed. This is a third name, and it changed because we've had changes in Attorney General. So McAnally was a very short-lived interim Attorney General. Bondi is now the new Attorney General that has been confirmed. So when she got confirmed, the name changed again. That's why it's now Texas Top Cop Shop versus Bondi is the name of the case. We have a change in Attorney General. So in any event, that's where we're going down here, Texas Top Cop Shop ruling. So what they said is there's a strong presumption acts of Congress should remain in effect pending a final court resolution. Courts should not be issuing preliminary injunctions in this area, and district courts definitely should not be issuing them, right? They also point out to the district court that Supreme Court stay in Texas Top Cop Shop is demonstration itself the government has a likelihood of success on its merits, because if the court believed they didn't, they would have left the holding in place. So, yeah, it's like, guys, read the tea leaves, read the room. Those 9 are going to rule, and we have now a real good sign of how they're going to rule. So maybe you want to kind of take this thing away right now, right? Government contains the balance of harms and equities favor the government, and there's not a huge cost to entities to continue to comply with this, right? So government's asking the court to stay its order, right? If granted, they plan to extend the compliance deadlines to 30 days while they assess potential modifications. And the government is also requesting, at a minimum, that the stay be limited to the named plaintiffs in the case. All right, so drop it back there. Now, they're asking this, plus they filed an appeal with the Fifth Circuit. So, and the question now becomes, and I think the district court has to think, look, if we reverse this and leave it in place for the plaintiffs, that's probably the best result we're going to get. We're going to be allowed the Alabama fix, right? And the feds may not worry about that. If we don't, there's a very good likelihood the Fifth Circuit will reverse us. And if they decide to try to dig in, then it's pretty certain Supreme Court's going to reverse. So it's like, I would find it extraordinarily surprising if the Fifth told Supreme Court, oh, no, you guys are wrong. They might believe they're wrong, but you got to realize that, you're telling somebody who has absolute control they're wrong, and that's not the most persuasive way to approach it. And, the theory being that this order is, as I kind of said when the Supreme Court decision came down, if it's questioned, this order is probably dead. So we're going to see what happens, and if the court does that. This was filed on the 5th. Probably the plaintiffs will have an option to file the response. That'll be the more interesting one to read. And I'm sure they're going to try to argue why their case is different. But remember, the bottom line is you can distinguish any case from any other case. The question is whether it's distinguishable in a relevant manner, which I think is a tougher argument to make in this case. And then they would issue their ruling. And we do expect that if they issue the ruling and the district court doesn't back down, then of course the government will go for an emergency ruling from the Fifth Circuit. And we all know what's in the background. The other interesting thing the court cited here, it's not on the slides, or the government did, they specifically mentioned Justice Gorsuch's concurrence, where he said, we really should review the whole issue about district courts issuing these nationwide injunctions. And it's fairly clear that Justice Gorsuch believes that, in essence, that there should be a ban issued on courts like this one issuing orders like this. So the other implied threat is, if you really push this all the way up the line, guys, you're going to lose this power entirely. So yeah, can consider what you're doing. Okay. Then on Friday, the other thing that made it clear that this is a pattern, and I've understood too, there may have been a filing in the Fourth Circuit on Friday too for an appeal of a case that went for the government, with the government filing there. And so now we have a government brief in Texas Top Cop Shop, as I said, versus Bondi now, our new Attorney General. Her name is now made it into the case, right? So yes, guys, the case is the same. Third defendant named, lead defendant, but the lead defendants have all been U.S. Attorney General. So yeah, Garland, McAnally, and Bondi, they're just defendants because they were there when something happened, and we had they're the U.S. Attorney General at the time. So this was a government brief filed with the Fifth Circuit. Now, this one's interesting, not because they're asking for immediate relief, but they're going to say appeal the district court's preliminary injunction and argues for reversal. Remember, what the Supreme Court officially did was eliminated. They said, no, this injunction cannot stay in place while awaiting the Fifth Circuit to rule in this area. And even if the Fifth Circuit rules that, that in fact that the district court was proper, the injunction is proper and should stay in force, it still really wouldn't go in force until, in essence, the government either fails to ask for certiorari, which seems almost impossible they wouldn't, or the Supreme Court doesn't grant it. And also, read the room, the fact that 8 of them decided to override the injunction to start with suggests that they're likely to grant cert. Because, by the way, there are a bunch of cases now moving. My understanding is appeals have been filed in the Fourth and Ninth Circuit. That there is one more in play, maybe the 6th. So we also have the 11th has already heard a case. The 5th has this case. It's coming at the Supreme Court rapidly. So yeah, the Supremes know it. I'm also thinking that's part of the reason for the ruling is this is to tell the courts of appeal to get in line. You all give the same results, so we don't have to pick this thing up. All right, so you all get in line. But otherwise, we got to grant cert in a case like this. And we'll see how it works. So this is just the government asking for reversal of the injunction, right? Again, the same reasoning is just repeated here. We saw before in the briefs that were put up forth under the prior administration. Again, the government argues that it will succeed on the merits, that the CTA falls into Congress's power in the Commerce Clause, regulating state commerce. It also is necessary and proper to execute Congress's powers to adopt this rule. They claim it also falls under the taxing powers to collect taxes, assistance in that. That comes in, and it also is Congress's, CTA's enforcing prohibitions against designed to advance U.S. foreign policy, policy and regulate foreign commerce. In essence, Congress has a ton of ways that they are specifically authorized to do what they did. The government is likely to succeed on the merits of the case. Again, this is a requirement to give that injunction for an injunction to be valid. That they did not, it had to be shown they were not likely to succeed. They also said the court totally fouled up in going after and applying a facial challenge and saying, okay, it's unconstitutional, period. They said the district court facial challenge analysis was incorrect. It requires a facial challenge requires showing no set of circumstances exists under which the law would be valid. The courts have never required Congress to legislate with specific exactitude. What the argument is here is that individuals who are harmed, the subclass that's harmed, those people, assuming that Congress did go beyond its authority, potentially because of the theoretical LLC that was formed and never, ever, 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 ever will engage in any commerce aside from local non-interstate commerce, which, by the way, guys, is really hard to do. Almost everything we do is interstate commerce or foreign commerce. The mere fact you're listening to this or you got this over the internet, means it's interstate commerce because I'm sitting here in Phoenix. I'm going to upload it to, servers for, YouTube, basically for Vimeo and for Libsyn, who hosts the audio version, which all have those in other states that aren't Arizona. They're not all sitting in Arizona. And you're probably not sitting in Arizona, right? If you're not in Arizona. So bottom line, this is part of interstate commerce, right? The mere fact that I'm posting this on YouTube puts me into interstate commerce, right? Bottom line, I'm doing that. So that's arguably an interstate commerce issue. Lots of those things are happening. So it's very, very difficult to avoid it entirely. But in theory, if you had an entity that literally did manage to only engage in activities that were Arizona and only in commerce entities that only engaged in activities in Arizona, well, that particular harmed party could be granted specific relief. That's fine. But, what they're saying is, of course, that's not what we're doing here, right? We're saying it's facially invalid, even though at best it would be invalid if you accept the fact that it would violate the Commerce Clause because there's some non-commerce, non-tax-paying, non-foreign, the whole thing, LLC that never gets involved in any of that. That would be a minor limitation. Also, equitable factors and nationwide relief are both a problem that they think is not supported. They said the district court's order threatens significant irreparable harm to the government and the public. I will remind you that in her dissent, Justice Jackson was a little skeptical that waiting 2 months was going to cause the world to fall apart. Okay. So I'm just going to remind you, we had a dissent that kind of says there's at least one justice that decides at least the short-term denial wouldn't hurt anybody. But, again, 8 others apparently disagreed with her. So we didn't have that go. The government also argues there's a strong presumption of constitutionality, which attaches to every act of Congress that must be given weight by the court, right? They can't just say we're going to presume it's not. The government argues that the district court improperly granted nationwide relief. The relief should have been granted solely to, if any relief was justified, it should have been limited to the participants, to those involved in the case. The government argues this is a backdoor way of doing what's prohibited class action style suit by getting nationwide injunctions. Instead of suing on behalf of the class, we just sue on behalf of one person and then get a nationwide injunction. And they also point out it encourages, forum shopping. There are 600 U.S. district court judges. You bring cases in a bunch of places, which does appear to be somewhat of a strategy involved here because there are a lot of cases that themselves make no sense why an individual would have brought them for their own relief, right? It would be very expensive to have brought it. And so and really it was to try to get some sort of nationwide injunction in play. And that probably is the case. That's also why it's going to be interesting to see if there's what the response is in Smith, because I'm not sure that those who are footing the bill for the Smith case, which I suspect are, as always, there are groups that are involved in these. That's the way we do these things. That's how we do cases. Done cases like that for years. I'm not sure they're interested in just, having Ms. Smith be protected. Right? That wasn't quite their goal. We're going to have to kind of work on that. and see what's there, right? And that's also the government's case that the relief should be limited to the parties in the case and not encompass foreign persons, right? So all of those should be there. So in conclusion, the government argues that the district court erred by concluding the CTA is unconstitutional, issuing a nationwide injunction. They contend the CTA is a valid exercise of their powers and the balance of equities firm of the government, and they cite numerous cases, statutes, regulations, and other authorities support their contentions. As I said, fundamentally, they're arguing that the theory that the Commerce Clause theory, the big argument usually is over that. And that is, and in every one of these cases, their argument is the plaintiffs in front of us cannot show a single LLC or corporation, that they're involved with that is not involved in interstate or foreign commerce. So the IRS argument is, and by the way, the argument of the 3 district courts generally that have ruled and said it is valid is, we're not going to accept a theoretical violation. We need to find the actual violation, right? So bring us an actual violation. Don't bring us a theoretical violation. And my gut's telling me, watching what the Supreme Court did, that that's where we're ultimately going. So my bottom line is I started December thinking, and I even started January thinking that, there's a reasonable chance that this whole thing might get struck down, or at least the administration might decide to soft pedal it, and, do various things. I'm now beginning to feel that no, we are likely to see this thing come into play. We're likely to see it come into play sooner rather than later. And I would certainly hold a conversation right now with your clients about, are you going to be able to assist them? If we get a deadline, when we finally know what we can do and what we need to do and who can skip filing, and we discover that you can't skip it, will I be able to assist you, or will I be able to assist you in determining if you meet the exceptions? So if you need somebody to help you file the report, I'd be tempted to tell a client who's saying, well, I want you to help me, but it's not required, so I don't want you to do it. We're not going to do it yet, saying, okay, here's your choice. Tax season's coming up. I've got solid commitments coming up here very quickly that don't move. So either file it now and I can assist you, right? Or if you're not going to do that, then find somebody else to help you, because I'm not going to be available to help you. I could have been available to help you on January 1st, 25. That was a much better date for us. But if the date turns out to be, March 16th or April 1st, it's going to be much more difficult for most of us to do a lot of helping in that regard. So I definitely put your clients on notice. It's like, I'm not saying you should file. I'm not saying but I am saying just understand you won't have assistance, and you got to take that into account. You need to, at best, as I would tell any client right now, I'd say at the very least, if you don't want to file, figure out how to file, what you have to do to get it filed, which is actually real simple to upload the PDF, assuming that they're at all can handle a computer. And gang, if you're going to play this game and wait till last second, you better be able to handle the computer. And number 2, just get it ready. Don't file it. But get the paperwork done. Get everything ready to send in, and you ready to push the button. So if it says go, you'll be able to get it filed before the due date. But as I said, I can't guarantee I can help you on January 1st. So this has been the current federal tax developments for the week of February 10th, 2025. You can email me if you have any questions, edzollers@currentfederaltaxdevelopments.com. I also do keep an eye on the sites for the Connect sites for Arizona, Idaho, New Jersey, Illinois, Minnesota, Washington, those states. So if you have questions, you can pose them there. Otherwise, keep your eyes open. Hopefully you'll have a good and prosperous week this week. We'll say, you all know the brokerage 1099s. This is brokerage issues, consolidated 1099s. First wave week is coming in this week. So I expect by next week, a lot of you will have a lot more stuff sitting in your offices, because all of your clients who have brokerage accounts, which is probably most of your clients, will now have gotten the last piece of data from the outside world, except for their K1s that they're waiting on. And I expect, as normally happens, this is when the flood of returns begins to come in. So good luck with the next week. And we will see you next week with more on current federal tax developments.